What is up, everybody? Welcome back to another episode of Fed Watch. My name is Ansel Lindner. I'm here with my co-host, CK. A little bit different on the intro there, but how are you doing, CK?
I am doing good. I'm trying to play producer and make sure that Rumble is working here. I know that we got YouTube and Twitch and Twitter going, but it seems like we're having some streaming issues with Rumble.
Oh,
So
no.
I apologize, y'all. Actually, just give me a second for these technical errors. I'm going to run the intro and yeah, hopefully I can figure it all out.
All right. We'll be back in a sec. And we're back. Did that
Yeah,
fix
we're
things?
back. Yeah, I don't think I fixed Rumble, man. So we might have to just proceed with just YouTube. But these are the qualms of not having producer Chris here. So
Yep.
it didn't take that long. We already miss him. We already miss the guy. Um,
Absolutely.
Ansel, let's
Yes.
get into macro. We got quite the list of things that we need to talk about today. I guess before we get into it, we should do some housekeeping. Y'all, Bitcoin 23, as you can see right here, I will be at Bitcoin 23, so will Ansel Lindner. And man, it is going to be quite the fucking event, y'all. It is going to be absolutely banging. It is going to be tens of thousands of Bitcoiners coming together during a bear market to celebrate Bitcoin. Uh, I'm looking at the chart. Maybe, later on we'll talk about if the Bitcoin price will be higher during the Bitcoin conference. We're about 42 days away. So a lot can happen in Bitcoin in 42 days. But the speaker lineup, the agenda, it is coming together spectacularly. And I believe that we've recently confirmed that Ansel Lindner is going to be jumping on the news desk to open up the event and to shed some knowledge onto the virtual viewers about what is going down, what we can expect, analyze some of these upcoming talks. So really, really excited to have Ansel on the desk. Wish I could be there with him, but they got to split up the dynamic duo when it comes
Yep.
to the live event. But y'all, ticket prices go up this Friday, so this would be a good time to buy a ticket. You can save 10% when you use BM Live, and you're not going to want to miss it. I believe Beefsteak Josh, just announced the Miami Beefsteak, which is on the 18th. A lot of stuff is going on in Miami. The event is Miami 18th through the 20th, and it's going to be the entire Bitcoin ecosystem coming together. So get your tickets, b.tc/conference, use promo code BMLive. Come say hi to me and Ansel. I'll be giving away sovereign individuals. But yeah, Ansel, let's go to you. What's your housekeeping?
Yeah, I mean, well, I'm excited for this conference because, well, one, I think we'll be out of the bear market. We kind of are out of the bear market. It's Bitcoin Spring in Miami 2023. So that's going to be great. And as well as, this is our opportunity as a very diverse community from around the world. We have all sorts of industries, all sorts of sponsors, all sorts of attendees, all sorts of speakers. I mean, the convention center itself, is just a diverse group of people. So this is a way to push back, I think, against some of this Operation Choke Point FUD that has been going on. And I can't wait. It's going to be a banging time. My other housekeeping is check out bitcoinmarkets.com. That's my website. I live stream on YouTube and Twitter and Telegram myself. So check that out for more details. Today, we're going to jump into the charts. We're going to touch on gold. We're going to touch on the dollar. We're going to touch on some other things like treasury yields, all the important charts that we kind of cover on a weekly basis to make sense of what's going on out there. We have a big OPEC announcement. We're going to jump through some stuff about OPEC. ISM PMIs, that's the Purchasing Managers Index stuff, where you look at manufacturing, non-manufacturing sectors of the economy. both in the US and China, the two largest economies in the world. We're going to check that out. And finally, look at US jobs numbers. A couple surveys came out about those, and we're going to kind of step through all of that. So if that sounds good to you guys, make sure you like, comment, subscribe. Sorry, no Rumble right now. Maybe we'll get it fixed here halfway through the show. I don't know, but we're going out on Facebook Live. I mean, there's all sorts of platforms where you can find us. Make sure you're subscribed.
Hey, Bitcoin Magazine podcast as well. So thousands
Yes.
of listens come in through the Bitcoin Magazine podcast to FedWatch. So y'all, let's just jump into it. And yeah, sorry about Rumble. Chris set it up, and I don't know what happened. Rumble, the integrations with the streaming platforms, it's just not at the level of everyone else. So I wish it was only on us, but it's kind of on them too. Nolan Bowerly's The Breakup is not on Rumble for those very reasons. But yeah, let's get into it. You want me to bring up a chart? Should we jump into price?
Yeah, let's do the first one. Bitcoin. We have to ground our conversation in Bitcoin. And
Always.
What we're seeing right now is, I mean, further consolidation, just pushing up on this $30,000 resistance. And
give me 1 second to bring this bad boy up.
Yep. Well, we've been in this resistance or this kind of zone consolidating now for a couple weeks. And I mean, it's possible that we fall out of here, but the way this is looking, it's looking more and more bearish. Each dip is a little bit less bad, and we keep pushing up on that $30,000 mark. So will we break through? I think the important level to watch is 28,500. That's what I've identified in some of my analysis. So if we can get above there and close above there, I think we're going to slide. I mean, if you remember, the volume by price indicator, it's kind of the hills that are on the right-hand side of the chart usually.
Yep.
If we get over 28,500 and close up there, we're kind of sliding downhill on the volume as price is going up. So I think that is a very important level to watch. So that's my daily Bitcoin analysis. CK, what do you got?
Yeah, I mean, it wasn't that long ago. I think it was like last June actually, where 29K, or maybe it was it was June. It was like mid-June. 29K was support, right?
Mm-hmm.
And it's been a journey since then, kind of on this Bitcoin roller coaster. But this seems to be the moment where we're battling with that same line. What used to be support and, really was the last giveaway before complete free fall in price. And now we're earning our way back and reclaiming those levels. So it's an interesting battle to watch here on the Bitcoin price. I've been intrigued. I've been commenting on the price action, which is something I don't often do on Twitter and on Noster. But it's just interesting to see, like, when will we defeat this resistance? When will we break out above 2850? When will we break out above the 29 level and above the mental, clean number of 30K too? Once we dominate 30K, I really do think that that is kind of a new bullish paradigm for Bitcoin.
Yeah, and it's interesting in the respect of the low liquidity on exchanges. If this gets going, FOMO could set in pretty rapidly, or panic, either one, because there's not a lot of liquidity on the exchanges. So we're coming up. We're continually pushing up tighter and tighter into this consolidation, and where it goes from here, we'll have to wait and see. But there are some big things coming out. Like next week, we have CPI, which would be a big thing. If it undershot the expectations, that would go more towards a Fed pivot, and I think that could affect the markets. We also have the establishment surveys for employment, which, one of the things that Powell has been hammering home recently is just waiting on employment numbers to turn, and that is when they are going to kind of know that their job is done on the tightening cycle. So a couple big items coming up in the next week, and maybe that's when we see Bitcoin's mind made up which way it's going to go.
Hey, shout out. We're going to be covering all of that stuff as we do always on FedWatch. Again, one of the very few Bitcoin shows and macro shows that has a complete picture kind of following through with what's happening in macroeconomics, what's happening in central banking, what is happening with Bitcoin as the future of where all this goes. So we take it all into account. Ansel, before we jump into the gold price, which is doing some things right now, what do you feel about Project Choke Point 2.0 and kind of what we're seeing is like the clamping down of Bitcoin off ramps, both in the U.S. and globally? We just saw Paxful have to close down due to internal drama as well as compliance costs. But what are you seeing kind of like with this clampdown of exits and off ramps from fiat into Bitcoin and crypto?
I've been talking about it quite a bit on my show. I think it's mainly a crypto phenomenon and not necessarily a Bitcoin phenomenon. I also listened to a recent appearance from Corey Clipson on a different podcast, and he was talking about Operation Choke Point 2.0 as, it's just common sense. Okay. There was so much fraud going on in DeFi and in these different altcoins and all over the place. Mismanagement. He brought up several companies that I'm sure he knows very well that they were being mismanaged. And so this FTX thing blew up, really shone the spotlight onto the space that these aren't just toy companies, these are real companies and they need to be looked at by the regulators. And so Corey Clipson broke it down where there's no such thing as Operation Choke Point. It's just like the maturation of the space, getting more attention from regulators and applying existing rules and regulations to crypto, not necessarily to Bitcoin. I mean, at Swan, they're unaffected. There's a lot of Bitcoin only companies that are unaffected. So that's how I view it. Corey Clipson, he said it better than I could. I hope I did his position justice there.
Yeah, I kind of I understand your position, and I also have a slightly different perspective. While I agree with this idea, like it's common sense to crack down on like clear and obvious fraud, and honestly, I think the SEC and regulators are incompetent because it requires like the biggest explosion in their face possible for them to actually look at something. So they, in hindsight, they don't actually protect consumers because the consumers all got hurt already. But with that being said, like it makes sense. Like there are a lot of things that are cringeworthy in crypto, and that we like like them or not, regulators with their current kind of jurisdiction have right to crack down and question them. But Bitcoiners, maybe not Bitcoin, but Bitcoiners and Bitcoin companies definitely get caught in the crosshairs of this. Banks, unsophisticated, these are not sophisticated actors. They're like, Bitcoin equals crypto, crypto bad, FTX bad, close all accounts that have any sort of like connection to, right? Not even like I'm buying Bitcoin or making money and selling Bitcoin and depositing that to a bank account, but it's like getting paid by a Bitcoin company in fiat is enough to flag and close your account as an individual and as a business. It's like that level of like that's not good for end users at all. And I think that there's a reason why we have to replace this decrepit HIT system. But here we're living in the present. We're trying to move forward and navigate clown world with Bitcoin, and we're getting more and more hurdles thrown in front of us as individuals. It sucks.
Yeah, they're going to. I mean, but if this is the fight you phase, it's not that bad against Bitcoin. I mean, individuals getting taken down, like you say, maybe accounts getting flagged or closed for individuals. But overall, for the space, this fight you stage is not that bad so far. And I expected much worse. I'm a long time holder, and I've been expecting, the government to come after us much more than they have in the last 10 years. So I guess it depends on whether you see the glass half full or half empty. Bitcoin is going to win. We just have to hold on and wait it out. So that's my thoughts, I guess. All right. So this is the gold chart. Oh, you're muted.
And yesterday, Satoshi's 42nd birthday, according to
Yeah.
what he input, and it is actually the 90th anniversary of Executive
61.
Order 6102. So pretty timely here that we're talking about gold. Gold also a currency a money that some really believe to have been neutered by paper markets, by regulators, by central banks. So very interesting seeing gold these days. Let's talk about it, Ansel.
Yeah, gold is a huge paper market. So most commodities obviously trade on paper markets with futures and stuff like that. Uh, I think oil is about 60% paper traded and only 40% like the deliverable side of the house. But gold is something like 95% paper trading. So that's why people think there's a lot of room for manipulation. And there is, but eventually that there is a piper to be paid here. But yeah, this is the price of gold. We are still not at all-time highs, but it has had a very nice rally here over the last few weeks. And I don't know why I wanted to talk about this other than saying, you know, gold is going up. Bitcoin is having a good little run here this year. Also, the dollar, even though the dollar is currently dropping, the dollar is stronger. So there's all sorts of weird things going on in the market. We just have to keep our eyes out and see what's going on here. Another thing I want to mention too is gold's overall market cap is north of $10 trillion. It's up there at $20 trillion for gold's circulating supply or market cap. And that's where Bitcoin has to get to be seen in the same light, as a true monetary competitor. But yeah, gold and Bitcoin, monetary alternatives, and they should do well in a deflationary environment like we are seeing right now. Any other comments on gold, or should we go to the dollar?
No comments on gold. Yeah,
Okay.
let's go to the dollar.
So the dollar, like I mentioned there, actually, if you go to number 4, CK, this one is, you can see it's been down for pretty much, I think it started back in, what month was that? About October or so, it peaked and it has rolled over. A lot of people are seeing this recent move down as like the end of the dollar. There's a lot of FUD out there about BRICS currency or the Chinese yuan or the dollar losing global reserve currency status. I think most of those things are overplayed. And if you zoom out on a longer term time frame, you can see, I mean, right now we're just hitting the highs that we hit back in COVID. So, I mean, just go back a couple years, the dollar was much lower than it is today. It's stronger today than it's ever been. It's a larger, it continues to increase its proportion of reserves, not decrease them. So, I think a lot of this drama over a new fiat replacement for the dollar is overblown. CK, what have you read or seen recently about this whole controversy on the dollar losing its reserve currency status, and what do you think?
The narrative around the dollar is as flippant as the narrative around Bitcoin. It's hyper Bitcoinization, or Bitcoin is dead, and with the dollar, it's the dollar milkshake theory, or the dollar is losing its reserve status. I think that it can be both, frankly. I think the dollar can be psychologically, politically losing its reserve status, and then simultaneously, the dollar's importance and stranglehold amongst the general fiat system is continuing to increase. And its use as a kind of like, as a contractual instrument will continue to dominate. So, I think the way that happens is because, exactly like you say, the old system is depleting, right? It's deflationary. It's breaking down. The ability to create growth and wealth within that system is continuing to decrease. And I think right now we're in the scope right now where the dollar is psychologically and politically losing its reserve status. And that is the opportunity for Bitcoin. They're going to try to fill that void with shitcoins. They're going to try to fill that void with fiat. But Bitcoin is going to be the system with actual growth. Bitcoin is the system that's going to enable more energy production. Bitcoin is the system that is for enemies, that is trustless. And I think Bitcoin will fill that void. That is the opportunity for Bitcoin.
Yeah, great points there. When I say that the dollar isn't losing reserve currency status, I'm mainly talking versus other fiats. All the talk about like the yuan getting a higher market share or a new BRICS currency. Nobody talks about the euro getting a higher market share right now, but that is kind of a tangential argument to the money side, because if you look at the world reserve currency for the last several hundred years, going back probably 500 years, it's always been either gold or silver backed. It doesn't matter if it's denominated in guilder, if it's denominated in Spanish dollars or in British sterling. Those are precious metals. Right now, this is the first time in recorded history where we haven't had a commodity backed currency. And so we're not going to go from one non backed fiat to another non backed fiat. We're going to go back to a commodity currency. That's my argument here. And it's very, very easy for the government. Well, not very easy, I guess, but it's logical for the government to do a reverse 6102 one day. Like, hey, we're going to go back to backing the currency with Bitcoin or with gold. And that would solve a lot of the problems that we see out there, because all these bank runs happen because the assets that they count as assets, these banks, they're just counterparty risk. It's somebody else's debt. And if that's what you're basing your asset side of your balance sheet on, that is extremely fragile. So you have to have some commodity on the asset side of your balance sheet to make that less fragile. And it's just a very common sense thing that I think will happen. But okay, that's my tirade about the dollar. Should we go on to the
No,
next one?
it makes complete sense, and it's much, much more logical than all the fear mongers like screaming inflation every time they can. And again, one of the key points of this show is really hammering home CPI equals a basket of prices. It does not equal inflation. So it seems so simple and logical, yet it's still the lingo. It's still the mental direction of the smartest people, the central bankers, and the dumbest people. They're all speaking the same language, at least when it comes to thinking about the dynamics of inflation. It's very simple minded.
Yeah. Oh, and another thing that what you said there a minute ago, that it could be both. It could be breaking down and getting stronger at the same time in different aspects. That's somewhat what the dollar milkshake theory is, that as everything is breaking down, the dollar actually strengthens before it dies. Right. And so that's kind of what we're seeing here as well. But a strong dollar means a slowing economy.
Yep.
That's what it means, because there's no other use for the dollars except to hold them as dollars. You want to have a use for dollars out there in a vibrant economy with some velocity and some business and some investment and all that stuff. And if you don't get that, then you start getting a stronger and stronger dollar. So it all plays in. All right, let's go to number 5 here. That is the Treasury bonds. These are the long dated ones. The black one is the 10-year. I want to hone in on that one, as well as that top kind of teal color. That's the 2-year. You can see that has dropped dramatically. Both of them have dropped quite a bit over the last few weeks. That big drop that we see from a couple weeks ago in March was obviously the SVB drop and the Signature Bank drop and the Credit Suisse stuff going on. But it has not recovered at all. It's continuing to sell off at a less quick pace, but it is still going down here. These yields are going down. And what that means, the way I interpret this is, again, there's not a lot of use for those dollars. So it goes into safe and liquid instruments, which is U.S. Treasuries. And that bids up the price of Treasuries, and which means yields come down. So any comment on this chart here, CK?
This is one of the most important charts that we share almost every single week. And I think it shows clear as day that the Fed does not direct even the bond yields, the instrument that is most attached to their control. That's how little control that they actually have. So as Ansel points out a lot, if you look backwards, when the Fed was hiking, they were really following the market was leading what they were doing. The rates started going up before the hiking. And then now you can see, rates have kind of flatlined and now are going down, and they're clearly opposed to the Fed's current rate levels. So in no way does it look like the Fed is actually leading this market.
Yeah, and I don't know why people don't, why people have a hard time believing that, because if you just go back to, Alan Greenspan, who is the maestro, he's supposed to be one of the best central bankers in the history of the United States. He explained how the Fed funds works, how monetary policy works. They move the Fed funds rate around. How does that work? Well, he said it was a series of 1 year forwards. So people would just, price out what it would be for one more year and one more year and one more year. But obviously, when we look at this chart, that's not the case, because if that were the case, how could anything ever be inverted? And that it was the pinnacle of central bank thought just 20 years ago. They haven't really progressed at all. One of the things that Jeff Schneider talks about is monetary economics kind of died in the 70s. Milton Friedman was the last great monetary economist to talk on this stuff. People could say Rothbard, or people could say Hayek as well. But, it died in the 70s, and we really haven't made any great leap forward in understanding how this market actually works. But yeah, great chart. Okay, and that's all I have for the charts. Should we jump into the other data? What do we got going? OPEC was going to be the first one. So did you hear the story? What are your thoughts on the OPEC cuts? They cut 1.6 million barrels per day. It's supposed to start next month. It comes on the heels of last October. They also cut 2 million barrels per day. So they're really, really cutting production. People are scared this is going to cause inflation. I have a counter view to that. But what is your initial thoughts on the OPEC cuts, CK?
I'm really not smart enough to deeply analyze the OPEC cuts, but I do know that the last time you discussed this on the show, you kind of illustrated that these cuts, if anything, were just like marketing in terms of what was actually being produced against the quota and what was actually being consumed against the quota. It wasn't, the quota was already behind, or it was way too far ahead for any actual real market activity to consume that much oil. So it was kind of a nothing burger based on what you explained. My assumption here is that there's more to this story this time around as well. But again, I haven't been diving super deep into it, so I'll pass it over to you.
Yeah, there's a little bit more to the story. It's a little bit less data from last time. Last time OPEC updated their projections for demand, and not only did they cut 2 million barrels per day, but they lowered their demand forecast as well. This time I haven't seen really any similar data coming out of OPEC. But here is the latest production numbers from OPEC. January is the most recent that we have. And if you go all the way to the left, you can see that's the total OPEC plus production. The quota is 40.1 million barrels per day, but the actual production was 38.31 million barrels per day. So that's 1.8 million barrels under the quota. And what did they cut? They cut 1.6 million barrels in this most recent announcement. Now, there is some slight differences. Saudi Arabia said they're going to cut 500,000, individually. And when you look at the next kind of cluster of columns there to the right, they were producing their quota pretty much. So they don't have room to cut. That will be an actual cut. Russia has room to cut. Some of the others there don't have much room to cut. So these, I think, will actually affect the total supply of oil on the market, but not nearly at the 1.6. Half or a quarter of the announcement, the announced level is what the actual market impact will be. So that's what I was looking at. Let's go to the next slide, because I have a few other things here to tie in with this. I wanted to talk about oil futures curves. Now, they are naturally in backwardation, and that's a downward slope there to the futures curve. And that makes logical sense, because if you could get more money for oil in 6 months, you would leave it in the ground, right? So there has to be some incentive for you to bring that oil to market right now. And that's why these curves are usually downward sloping, what we call backwardation. Now, if you there is a problem to that, though. Usually that backwardation is somewhat gentle, maybe $2 to $4 over a year's time, something like that. But this, you can see 74 down to 55, or is that 65? And that's that's almost a $10 backwardation in just like an 18-month. So that's a huge thing. When backwardation gets really steep, that means that the market is expecting a slowdown, that demand should fall in the future. So backwardation is good, but very steep backwardation is not good. Also, I wanted to point out the little hook at the front of the oil curve, and that is actually a part of the curve that's in contango. So the second month distant contract is actually more expensive than the first. Now, that's the opposite of what I said before, where it's incentivizing people to take oil out of the ground. When you have contango like this, it actually incentivizes that oil to go into storage and not to come onto market, because you can get another couple dollars by just holding it onto it for a few more weeks. So that is what this little hook in the front signifies. It signifies current demand is really low, and then the steep backwardation signals that future expected demand is very low. So the oil market, the demand is falling off a cliff. Any comments on this, or I have one more chart that demonstrates this?
Well, I mean, it's fascinating to show that things are not healthy, right?
Mm-hmm.
Like there wouldn't be the contango at the front. There wouldn't be this steep backwardation. So what does this mean in terms of your analysis for what's to come?
It means that there is really no effect from the OPEC cut, because the demand is falling off a cliff and global recession is coming. The question now is which places in the world are going to be hit hardest by the recession, and what is the outcome, the nature and the outcome of that recession. Is it going to be a banking recession? Is it going to be, like a financial thing? Is it going to hit Main Street really hard? What are we looking at? And different geographies will tell you different things. But overall, this is a global proxy right here, the oil market, and it's telling us demand is crap right now. It doesn't matter that OPEC cut. But let's go to the next chart. This is
real quick before we jump to the next chart. Something that this reminds me of, and I'll actually go like way back to a relevant chart, but I actually think it's relevant, is these OPEC cuts. It's almost like the Fed chasing real rates with their rate increases. It's OPEC chasing the lack of demand. They're just trying to bring their numbers. They're adjusting their numbers to reflect lack of demand, rather than, they're attacking demand by constraining supply.
Yeah, great point. It is signaling. It is psychological signaling by OPEC, 100%. It also tells you that the China reopening was a dud. Everyone was waiting for China to reopen after zero COVID and storm onto the market and have all this demand, and it really isn't manifesting. Now, this chart, the black line is the front month contract, and the red line is the next nearest contract. And what you should expect if we are in backwardation, a nice healthy slope, is for the red line to be below the black line. And that's what we saw pretty much all the last few years leading up to this year, when the red line is still there. It's just completely underneath the black line, meaning that front backwardation has disappeared, which is a very unhealthy thing. Signals more incentive to put oil into storage rather than to bring it to market. So I thought this was a kind of an interesting way to show that. If you go to the next slide, this is just the oil price. Oh, go back one. Sorry. Yeah, there we go. This is just the oil price, and I highlighted with these arrows the first cut back in October. Didn't really do much to help the price, to keep the price stable. It did the price spiked a little bit and then it continued to fall. And now I'm showing the most recent cut. And will it have a similar effect that we will just see the oil price continuing to fall? Now, this kind of pink zone that I highlighted down below, $72 down to $67, that is the range where the US administration promised the world that they would start refilling the Strategic Petroleum Reserve. So if you go to the next slide, this is an official announcement from the White House, back dated in October 2022. And if you go to the next slide, partway down this, you can see the president is announcing that the administration intends to repurchase crude oil for the SPR when prices are at or below about $67 to $72 per barrel, adding to global demand when prices are around that range. This was the implicit promise that was made by the administration. Now, if you go back to the oil chart, number 9. Yep. Oh, one more. Yep. There we go. You can see as soon as the price fell below that promised range, where the White House promised to start purchasing oil for the SPR, that's when OPEC was like, well, we better cut again. Because there was no action from the administration, no addition to the Strategic Petroleum Reserve, and OPEC was like, okay, we got to cut our production because, of course, Washington didn't follow through with their promise. And there was some reporting that this decision was leaked early, and you can kind of see that in the chart as well. It bottomed and then it started going back up again, probably as certain players got the information that a cut was coming. But yeah, it's very interesting that this cut follows the failure of the administration to start repurchasing oil into the Strategic Petroleum Reserve. So that is, I got a couple more charts. If we go to number 12, this is the Strategic Petroleum Reserve. You can see it's about half full, and it's the lowest since 1983. And then the last slide that I have here is, or last chart for oil, is very interesting. This is U.S. oil production. And the latest numbers we have here are January as well, but I'm expecting February and March to also be positive months. We are right back near the all-time high oil production. And this is, in the face of OPEC cuts. It's also in the face of the SPR drain. The U.S. oil production is back near all-time highs. So I think that's important. All right, CK, what are your comments on this? Muted.
Absolute fireworks, honestly. Wow. This is, I think, part of the reason here that I think psychologically U.S. dominance is breaking down and is becoming like much less desirable is because of just the way that we administer foreign policy. And I would say just like maybe it's not a multipolar world financially, but I think it's a multipolar world influentially. And I think that technology, which is the most influential thing, while it's still predominantly coming out of the US, it's even more starting to pick up and gain steam and gain a grounding elsewhere. And that is very influential. So when we see the US, kind of manipulate markets their own way and not follow through on what they announced to the world, I think that like speeds up that breakdown. When it comes to the oil stuff, I have to kind of fall on your analysis where what it means and recession coming and it's starting to be priced in and demand is being destroyed. A lot of that makes sense to me. A lot of really great analysts, they say oil is the number one thing to follow if you want to know if there's a recession, if you want to know if there's growth. So it's interesting seeing this market do things it hasn't done for a while, and for it, like, textbook wise, behaving really poorly. So Yeah, I mean that's really all I have. But it's going to be interesting to see how the political nation state drama kind of continues to play out and what that means.
Yeah. Well, if you guys, the viewers, if you thought this was interesting analysis, I did a whole breakdown on bitcoinandmarkets.com for my premium membership over there. So check that out. If you use /pro50, you get 50% off your first month. So check out bitcoinandmarkets.com. Okay. Now, next we have the ISM data, PMIs out of the US and China. We also have jobs reports coming up. I think this will be a much faster segment. So let's jump in to this one. If we go to number 14 here. Yeah, so I took a lot of these charts from Jeff Schneider, so I wanted to give him credit up front. So most of these charts are going to be his. Next slide. All right, so this is the ISM Purchasing Manager Index. This is the manufacturing PMI, so obviously also making stuff in the U.S. economy, and it is just tumbling. You can see that going back to the COVID lows, starting to look a little bit like even the great financial crisis. So this is not looking good for the Purchasing Managers Index. Going to the next slide. This is, oh wait, sorry. So that last one was new orders. Sorry, CK, if we go back to that one. So the dashed line here is new orders. And what Jeff is showing here is new orders are leading here on the downside. So probably further downside to go to this ISM manufacturing PMI. Okay, so the next slide is employment. Very similar picture to previous recessions. And this just looks bad. I mean, if you look at that orange line, it's been very volatile. It makes me think of the Fugoid cycle where it's getting more and more volatile as we go through here. But, this is very ugly, printing very deep into contraction territory. Next slide. This is the real GDP in these gray bars. So I thought this was a great way to kind of visualize how this affects GDP and where are we going? The textbook recession is 2 quarters of negative GDP growth. So when we get negative on the PMIs like this, we should expect a contraction in GDP. All right. Do you have any comments up to this point? I just have a few more charts.
I mean, your comment about this looking like a Fugoid cycle really struck me because it's just higher highs, lower lows, higher highs, lower lows. Things are getting even more volatile and even more contracted as they go. It's kind of wild to see that cycle over several kind of boom and busts.
Yeah, and the time frame is getting a little bit shorter.
Yeah,
So
exactly. That's getting more contracted. It really, like, that analogy fits very well to what we're seeing.
Yeah, and then eventually, what's the end of a Fugoid cycle? When the stress breaks whatever medium that's the wave is going through. So, I mean, that would be a great analogy to the economy. The Fugoid cycle will continue until something actually literally breaks in the system. But okay, so next slide is ISM Purchasing Managers Index for non-manufacturing. So that all that stuff was manufacturing. This is non-manufacturing, and you can see it isn't in outright contraction yet, but it is extremely low. And going back, other than the most recent dip, we have to go back to that middle dip. And I am having contact issues today, so I think that's 2020. Yeah. Yep. So very bad. Not as bad as manufacturing, but still the non-manufacturing PMI is looking pretty bad. Let's go to the next slide. This puts that real GDP in the back again, which I think is a fantastic visual here. And you can see there's like not a lot of hope for real GDP to accelerate here in my mind. Everything is going downward. And one of the things I've said for pretty much since I think I might have started saying it in 2019 with the repo rumble, but I know I've been saying it since COVID that we will return to a post GFC normal of low growth and low inflation. And that's what this is going towards. Recession, I don't think it's going to be a horrible recession for multiple reasons we don't have to get into necessarily right now. But you can see everything is slowing back down for out there in the economy, manufacturing, non-manufacturing, and GDP. Okay, what do we have next? Okay, next is China, but do you have any other comments on that, or should we just roll into China?
Yeah, I can jump in. Oh man. Well, you come in with the numbers. I kind of come in with like the man on the street, anecdotal type stuff. It feels like the the current environment, at least in terms of commerce, is like becoming more normalized, right? And companies are getting used to like the post layoff world. They have changed their forecasting to like recalibrate to what to expect in the future. With that being said, it does look like things are going to get worse, right? On paper, it looks like things are going to get worse. So I'm interested to see like if how flexible businesses and families are to adjust to that, because really the real pain is when you can't adjust your spending and things keep getting worse and then you're bankrupt, you're not solvent. So that's where that's kind of my mindset going into going into thinking about where the future leads for us. I'm very interested to see what 2024 looks like. And I think that this year is going to be fundamental because there's a lot of things that can go extreme in in both directions, when it comes to the economy, when it comes to optimism, when it comes to civilities. And next year is going to have a lot of weight put on it. So we'll see what the buildup looks like, right? And of course, the halving next year, always perfectly placed, always.
Yeah, I was looking back at the great financial crisis and the stock market performance during the timeline of different events that happened during that, mainly 2008 in the big lead up to the great financial crisis. And it was going down the whole time. And it also never got back up above the 50-day and the 200-day moving average like we have now. So there are some signals out there, I think, where maybe not this time is different, but this time won't be as bad. I don't know how to exactly explain that, but we aren't seeing the exact same buildup into this financial crisis that we did for the great financial crisis. And I know Jeff Schneider, where I took a lot of these charts from, he's out there really saying this looks more and more like a repeat of 2008, 2009. And I'm not quite there yet. So, all right. So that's all of PMIs. Sorry, did you have something else?
No, we got 10 minutes left, and
Right.
I think we both have hard stops. So we got a lot of content to go. So I'm just going to
Yeah.
let you fire through it, and I'll jump in at the end.
Okay, we can go pretty quickly through these Chinese manufacturing numbers. And okay, so this is slide number 21. They came out obviously this month with their numbers as well. We have to take China's numbers with a little bit more grain of salt than the US numbers. We have to take those with a grain of salt as well, but I think China deserves a little bit more. And so this is their non-manufacturing PMI. It is an expansion territory, but after, like you can see this Fugoid cycle here as well, what's coming next? Probably a slowdown. But this print right here, people were interpreting this as positive. If you go to number 22, this one is the China services
Looks
PMI.
exactly the same.
It's very, very similar. It's printing positive. Now, if we go back to slide number 20, this is the manufacturing PMI. And one more. Yep, here we go. Manufacturing PMI. And China, they're supposed to be the manufacturing powerhouse of the world, right? Well, they just printed a negative number here and right at the 50, which is the line between contraction and expansion. So definitely the China reopening was a dud. Their manufacturing sector, I think, is the signal here that they are slipping into contraction. And so the other chart I have to kind of demonstrate this is number 23, and it's the freight rates. So if you don't buy all this about the different PMIs, we can get a pretty hardcore number right here. We've shown this chart in the past. It's from Freightos.com, and these are the global container rates right here. I mean, there's no uptick. Okay, the economic conditions are not ticking upward. They're actually continuing to fall and deteriorate. So that's my China stuff. We can go right into the jobs data unless you have something to talk about.
We talked about the freight being a big indicator, and yeah, I'm glad you brought it in here. But let's keep rolling.
Okay, so slide number 24. This is, I just wanted to put this slide in here to kind of describe these employment surveys, because you might see headlines, oh, ADP, oh, JOLTS was out, or the household survey. So this kind of breaks it down a little bit for you guys. JOLTS is by the BLS, the Bureau of Labor Statistics in the United States, and it talks about job openings and hiring data. That's what we're going to go over here in a second. ADP, this is a private sector firm that does their surveys on the employment environment in the United States. Then the two big ones from the BLS are the non-farm payroll, and that is counting jobs, not people. So if you have two jobs, you count as two numbers in the payrolls data. Then the household survey is also from the BLS, and that counts people, not jobs. So I just want to make sure people can maybe get a better understanding of all of these different job surveys that come out. That's kind of a breakdown. Okay, next slide. So we're going to talk about the JOLTS. That's job opening and labor turnover survey. Next slide. Once again, from Jeff Schneider, he puts together some great charts. And you can see the black line is the number of hires, and the orange line is the number of job openings. And what Jeff is pointing out here is that the orange line has a lot of irrational exuberance in it. It gets ahead of its skis, and then it kind of comes back down to reality. And man, oh man, if that is the case, what is going to happen to this orange line right now? It's going to catch back down pretty rapidly to the hires numbers. Next slide. This is just a little bit more vanilla way to look at this. Zero Hedge took the 2-month change, and this is like you can see that bottom half of this chart is the 2-month change, and it's the worst since COVID. It's the third worst 2-month period in the data series. So it's a pretty big amount of job openings that are being lost, I guess, or I don't know how you would describe that. Okay, next slide is hires, and you can see this is back to mid 2021 levels and dropping. So just think of Jeff Schneider's double line chart where he showed the job openings compared to hires. If hires are falling, job openings are so much higher. Most likely it's going to be a painful ride downward. Okay, next slide is we're going to talk about the ADP, and I don't have much to say about this one. Again, this is the private sector survey. And if you go to the last slide, this is the chart that they put out with their recent data this week. Employment is slowing down. It's still positive for the ADP, but it is slowing down. I like this time frame that is included on this chart because you can see 2019, and 2019 flattened out, started downward before COVID hit. So the market already knew, the market was signaling what was coming. There was some major disruption coming, and that's what we should expect this time as well. So if we project out into the future, we have maybe 6 months to a year in this time series. The way I would kind of forecast going forward, that it would signal some sort of major financial event. So that's it, CK. Any comments on the jobs market data? And then I think we're done here for today.
Fascinating stuff, honestly. Really fascinating stuff. I would say if you're watching the show, this is where you got to go onto YouTube and actually check out the charts, because it really shows like strong trends, and it's scary to kind of see openings falling, actually new jobs falling, seeing this slowdown, and like we're talking about like the slope of the curve changing significantly, and if it starts going back down, if you look at the last chart that we had up here, it took less than a year and a half for crisis after that. So that's crisis like in the next 2 years, right? That's kind of like what if this signal, if the private employment based on ADP does the same thing.
That's
It's going to be interesting.
that's kind of a scary thought, to live through 2 more years of FUD, that the dollar is losing currency status, and there's all these banking failures, and the economy still chugs forward for another 2 years before something happens. But yeah, also I wanted to point out that I showed those 4 different employment surveys. So the people that say that the U.S. government is manipulating the data, well, they are. There's a lot of different sources of these data, and so they can't be manipulated for long. And that's what we're seeing. People are talking about revisions to previous employment data that's going to be coming out this week. So be watching out for that. But yeah, CK, thanks for hosting.
Yeah, man. I was busy. I was going from screen to screen trying to fix Rumble. So we definitely miss producer Chris. He does an amazing job, and we really appreciate him. And y'all, thank you to everyone who tuned in. Again, sorry to the people on Rumble. We will be back next week 100%. Chris will be able to make it happen. Thank you to Ansel for putting on the show. Come see Ansel and I at the Bitcoin conference. Use code BMLive to save. And y'all, you're not going to want to miss it. It's going to be live on Bitcoin Magazine, YouTube, and on Rumble. So if you can't make it, we will be live streaming. Catch Ansel to open up the show on the live desk. But that's it from me. See you guys in Miami. Peace.
See you guys.